Welcome to the Africa Capital Markets panel. Good to see a lot of people here. I know we are running kind of late, so let us just get into it. I want to introduce Dan Keeler, who's from the Wall Street Journal. He's really, really passionate about consumer markets, about Africa, and I'll let him moderate the panel for us. Thank you.
Thank you. Is this microphone on now?
No. Okay. It's low. It's low.
It's low. Is it better there?
No, someone needs to raise the volume on all those mics. We just had one
Yeah. Is it better? How are we doing? Better?
No, I guess speak up.
Okay. Well, welcome to the Capital Markets panel. Thank you for coming. I'm thrilled to be moderating this. We've got some very, very experienced and talented people on the panel. I'm going to keep the introduction brief because we've got there below in the program. So we have, to my immediate left, Alison Brea, who runs a frontier markets focused hedge fund. She's based in New York. She's rated there in addition to traveling around frontier markets. So she has, as an investor, she has a very deep and keen understanding of the reality of investing in Africa and the capital markets there. To her left, we have Brad Hicks, who is Managing Director of Mara Group, which invests in a wide range of pharmaceutical companies across the African continent. Brad is based in Dubai and she's responsible for sourcing and evaluation of investments. So again, has a very clear understanding of what it's like to invest in real companies in Africa. Next we have Terence Naidu, who is founder and managing director of the Envision It group of companies. I was going to say that I didn't understand what he does, but I suppose he explained it. So the company actually does securities lending, which is the foundation of short selling, and also enables you to create derivatives, which are a very important component of a developed financial market. So he's based out of South Africa, and we'll tell you more shortly. And finally, we have Amadou Si, who is a senior fellow at the Brookings Institute and a long-time veteran of the IMF. Again, great experience in capital markets has helped set up some capital markets, I believe, was involved in strategizing for the capital markets. So he's, again, very experienced. So welcome to the panel, and welcome to everyone here. The aim of this panel is to talk about the role that capital markets play in economic development and in individual financial empowerment, which I think is a key theme of this conference. So with no further ado, I'd like Alison to try and set the scene by giving us an idea of the size of the markets that we have in Africa and the diversity and sort of returns that we've seen across the continent.
Sure. Well, in terms of size, just to quote a few numbers, we look at sub-Saharan Africa, so we don't. All of these numbers I'm quoting will exclude South Africa, but include the rest of the continent. About 630 listed securities. About 250 of those have a market cap of over 100 million. So one of the issues that I'm sure will come up, on the panel quite often is this question of liquidity. And so already with those two numbers, you can see, where the problem begins. We have a fairly limited universe of listed companies overall, and when you exclude kind of the 5 million market cap, 10 million market cap, the universe shrinks very quickly. So 250 companies with market cap over 100 million. And then if we say how many companies in Africa, listed companies, have a market cap over $1 billion, what would you think the number is? Let's say, 80, 90? Nobody. 50?
25.
Well, that's first. Actually, it's 22 to be precise. Yeah, 22 companies with market cap over $1 billion, and of course, $1 billion in in our world is also considered small cap. So that's, one of the constraints of the market overall. Another question we often get asked is, what's the total market capitalization of sub-Saharan Africa? Say, any guesses? How much? 30? A little bit more, about 140 billion. But still, if you, to put that in context, Apple, market cap of Apple is about 472 billion. Facebook is what, 120 billion. Chevron 230. So there's any number of kind of individual companies that dwarf the market cap of the security markets in Africa. So anyway, just a picture of size. In terms of the performance, this year was a sea change to my mind. I mean, Africa had kind of done fairly well since the crisis, but as of January 1 of this year, for various reasons, things just started going vertical. So I think the average across the region is up about 25% this year. You have countries like Malawi is up 72, Ghana is up around 80% in local currency terms. So we just saw kind of a flood of money going into some very illiquid markets, and things have just run up very steeply. I think Tunisia is the only country in the region that's actually down so far this year.
Sorry, just to add to that, we spoke about market caps and those kind of things. Trading volumes and liquidity is quite an interesting subject as well. If South Africa trades probably about between $1.5 to $2 million a day, and the next biggest market is probably Egypt, which trades between $70 and $100 million a day. It goes down to about $30-40 million on a good day in Nigeria, to Kenya. I mean, you'd be lucky if you're trading $1 million a day. So liquidity is exceptionally low in markets other than South Africa, pretty much.
So, what impact does this have on valuations? You mentioned that valuations have pretty much gone vertical this year. Is that because of the lack of liquidity? We're seeing a lot of money flooding into Africa looking for a home. There's only a certain number of companies you can buy, so those companies get bought and bought and bought, and their valuations push up.
I'd say that's exactly the issue that we've been facing is a lot of new money coming into Africa. I think that the number of fund launches in Africa this year, just of people that I've kind of met and come across casually, at least 20, 25. Other new money we've seen as emerging markets fall a bit out of favor. They're trying to transition a bit more into frontiers. And so now kind of every mainstream emerging markets fund has an allocation to Nigeria and Kenya. Then we're also seeing a lot of the local pension funds that are having lots of new money coming in, and they play mostly in the debt markets, but when equity is doing well, they'll switch into equity. So we're kind of seeing lots of fund flows from different sources. In terms of valuations, one of the things that we keep hearing from investors, and we're a hedge fund, so we need to make absolute returns, but a lot of the money that's going in is actually, people will tell us, well, I don't care that Unilever is at 40 times PE because we're here for the next 20 years, and earnings will eventually catch up, et cetera. So I think there's a significant chunk of that money that's actually, valuation agnostic, as bizarre as that sounds to a lot of us.
Right. Well, so Brad, I mean, you're involved in investing in companies across Africa. What do you feel about the valuations? Do you feel like they've been pushed too high by the flood of money that's coming into Africa?
Well, at Mara, we're more focused on greenfield and growth equity opportunities, so at the opposite end of the spectrum. But that being said, just to challenge the valuation discussion, an example would be take the financial services sector in Africa. It's the most profitable sector in the world. The average ROE of sub-Saharan banks is 20%. The average price to book is 1.7. If you compare, and there are certain countries which do seem quite rich, but if you look at it in aggregate, given the underlying fundamental dynamics of profitability, increase in financial inclusion, the expansion of the loan books, the fact that they have the highest cost-income ratios in the world, which means there's huge opportunities on savings and the cost side, means that valuations in some sectors actually isn't bad.
Right.
Yeah.
What would you say?
And I think local investors would have been quite conservative in their valuations early on, but as liquidity in certain markets like South Africa grew, you had international investors coming through thinking, "My God, this is cheap," and putting valuations up to levels closer to US and European listed securities. I think the Dow currently trades at about 15 times forward PE, and JSE is probably at 14.6. I mean, initially when you started to see more flows come through from international investors, forward PE and JSE was closer to 10 to 11 times. So, international investors definitely saw value. There's a massive growth story there, and that's why you've seen the narrowing of the gap between forward PEs and international exchanges and the more liquid African exchanges as well. And just to give you an example of international exposure or ownership of our market, it's gone up from 20% for 5 years ago on the bond market, and now 40% of South African bonds are held outside of the country. So I think it's international investors coming in and seeing a lot of value in these markets and pushing up valuations closer to where they're comfortable with.
Right. Yeah.
But if I may, I don't know if you can hear me, but there's this issue of how sustainable are the flows that are coming into Africa, and what are the push factors driving the money into Africa, and what are the pull factors really attracting this money. So, as we will have some tapering off in the US with US interest rates going up, I mean, we've already seen when it comes to emerging market stocks, some outflow, some nervousness. Will it affect Africa or not? Then, you have basically other factors like also like the inclusion of some of these countries into some indices, right? So if a country suddenly is including in the MSCI Frontier Market Index, then suddenly it attracts much more flows. So I think it's good to disentangle the push and pull factors, because at some point, at least it will have an effect on the volatility of the valuation.
I think it's a good point. And actually, Alison, I'd be curious to hear your views, given that you probably take a more fundamental approach. But last year was all about risk on, risk off. We've seen it this year as well. You take a market like Kenya, 50% of Kenyan equities are 50% of the market value of Kenya is held by foreigners. That's a lot of hot money. And how do you manage to that? And I'm sure, Dan, I'm sure we're going to be moving to how do you create a more organically led capital market framework in Africa, but I'm sure we'll get there.
Right. Well, that's actually a good segue, because the role of the capital markets is to draw money and investment into a country effectively. One of the roles. How can African countries develop their capital markets in a way that will encourage responsible investment, not hot money, that will attract investment on a scale that's needed to help Africa to meet some of the challenges that it faces, without putting it at the whim of the international financial flows, which can be quite volatile and quite damaging. So who wants to launch into that?
Yeah, if I may, I mean the typical conventional way, is to say, okay, where is the money? Where is the investor base? Okay, so you have the foreign money, which is the foreign savings, and then you're trying to see where are the domestic savings. So in many of these countries, you say, well, where are the insurance companies? Where are the pension funds? Where are the institutional investors? You go to DRC, there's one big insurance company which is not doing well, right? Then you have the problem like if you look at the stock markets, you have the problem of very few large, high market cap companies. You don't have enough liquidity, And then you look at the money markets, you would see a lot of banks not even trading among themselves, but trading intra-group, because it's just easier. So EcoBank intra-group would trade, and Standard Chartered, and so on. Then you go to the local bond markets, and there you've seen some action. So the government has been issuing treasury bills and bonds and trying to establish a yield curve and so on. And so typically the typical advice is, okay, try to establish a investor base, do some pension fund reform, look at your insurance sector, and so on. But these things take time. So I think one key thing for Africa really is to think about innovation. So when you look at the investor base, for example, this is the second best solution, right? So it's not going to work all the time, but you have to think about it. If you look at the investor base, for example, if you go just next door to Canada, if you go to the province of Quebec, they have a Caisse de dépôt and placement, which takes a lot of institutional money, pension, and it is a huge institutional investor. They have it in France, they have it in Italy, they have it in Morocco, and so on. Then you have the governance issues, of course, but that's a different issue. Then how about the diaspora, right? You see, remittances are higher than aid flows now to sub-Saharan Africa, right? So Israel, India have been issuing diaspora bonds for a long time, right? So it's starting a little bit with Ethiopia and Kenya and so on. Then you have, and I'll be brief on that, you have the problem of market size. Well, if you're, 54 countries, small countries, except the Nigerias and the Kenyas and so on, well, how about regional markets, right? And there you have some movement, right? For example, in the Western African Monetary Union, you have 8 countries, 1 currency, and they have 1 stock exchange, which is based in Abidjan. So I know that in some countries this is a question of national pride. Every country wants its own stock market, but I have some issues with that. And then, how about just innovating? If there is Islamic money out there in the Gulf, how about Islamic securities? Malaysia is the 3rd largest bond market in Asia now, thanks to Islamic securities, the sukuk and so on, right?
Are you seeing any development of Islamic financing in Africa?
Yeah, so for example, in Nigeria, at least the regulators have you need some regulatory background, framework, so it's put in place. Senegal is thinking of issuing a sukuk. And that leads me, just I'll be brief on that, to infrastructure. A previous panel was saying there's a huge infrastructure gap in Africa. Well, how about infrastructure bonds? So if you look at the history of the bond market in the US, the prime bonds used to be the rail bonds, right? The railway sector was issuing these bonds, and they were the best bonds in the US, right? I'll just stop there. We could elaborate later.
Yeah, that's an interesting point to tie in the infrastructure needs with financial structures, because one of the things that's been a constant theme in my reporting on Africa has been that there's a huge amount of money that wants to get into Africa. There's a huge amount of money in Africa that wants to be deployed. There's huge need for infrastructure projects, and there's a gap in between the money and the projects. And just based on what you were saying, could infrastructure bonds, could some sort of financing structure be created that would work continent-wide, really, that would help to bring that money and the infrastructure projects together? Any thoughts? Terence?
We've seen it in South Africa where there have been infrastructure bonds predominantly taken up by the Government Employees Pension Fund, which is I think the largest pension fund in Africa. It's got 1.3 trillion rand. What's that in dollars? $130 billion. And we've had massive road infrastructure, and there's a company called Sandal that's developed that. But there's also quite a bit of activism against paying for that infrastructure. Road tolling and that kind of stuff. So there's a lot of political uncertainty and there's unions that are fighting against paying for tolling, and we pay taxes, so why should you pay for more infrastructure and that kind of stuff. So I don't think that's been the perfect example. They have tried it. Transnet, our ports authority and rail and stuff have issued bonds. Eskom, our electricity provider, has, and those have been very successful, widely taken up locally and internationally. But I think with issues that we've had on the road infrastructure and the bonds associated with that, which were predominantly institutionally taken up, I think there'll be a little bit more reluctance to issue more bonds until those issues get sorted out, especially if you want the public to pay to recover the returns on those bonds.
Do you get the sense that other African countries are looking at South Africa as a model and learning lessons from that?
Without a doubt. It is the most developed country from a financial services perspective, and I think African countries are taking a lead from South Africa. But we've got some best practices in the country that international markets could look at as well. And a prime example is in the industry that I'm in securities lending. During the subprime crisis, you had loads of naked short selling in the US and European markets. You're not allowed to do naked shorts in South Africa. We've had that rule since the inception of securities lending, and that stood us in great stead during the crisis, because if the source of shares to short comes from your pension funds, and if pension funds say that they only want to lend out 50% of whatever they hold, you're going to have to stop shorting at some point when you reach those levels. You can't just carry on shorting and rolling settlements or trades and that kind of stuff, which is exactly what happened in the US and Europe, UK, those kind of markets. So innovation, and policies and procedures that we had in place in South Africa could actually be templates for the rest of the world as well.
Just to pick up on the shorting or the securities lending, that seems, given that South Africa is the only country in Africa where that's even allowed, is that something that other capital markets in Africa will be looking at and following suit and saying we need to be able to do this?
I would hope so. I think Nigeria has looked at it, initially agreed to set up the environment for shorting, and then have pulled back for some reason. You've got to look at what's going to drive liquidity in markets. In my view, securities lending definitely does, because it's your foundation to do derivative trading, equity structures, hedging out structures, and the like. You've got to have index tracking funds. Those drive liquidity, because you always have to buy and sell shares that are included in the index. I think securities lending is definitely the foundation to do all of those things. It's something that people shy away from, or most jurisdictions shy away from in Africa, because they associate it with hedge funds, which are negative. Purely because of
So talking of hedge funds, we have a hedge fund manager here who is, I understand, frustrated at the lack of ability to short or to borrow.
Yeah, no, and I'll tell you kind of the quintessential experience we had with this is, sometimes we come in with our New York kind of sophisticated financial background, and we think shorting is a great thing, and all you need to do is set up the infrastructure, and if the facilities are there, people will do it, and we know how to do this, and so let's dive in and do it. And this was a few years ago that you can't actually. It's not prohibited borrowing securities. So in some place like Nigeria, we decided, let's see if we can put a short on in Nigeria. So the question is, first of all, you have to borrow the securities. So where do you go to do that? Well, the people that are holding large quantities of this that they could lend are the local pension funds. So we had a conversation with the local pension fund where we were trying to explain to them what we wanted to do. And the conversation was, so you hold these securities, and what we want is for you to give us these securities that, they're yours, you're holding them, in a fiduciary capacity for pension years. Give those to us for free. We're going to go out in the market and sell them, hope that they tank. Once they've, lost 20% of their value, we're going to buy them back, make a pot of money for ourselves, hand them back to you at 20%, lower price, and, and there we go. And oh, by the way, don't worry, but we'll pay you 50 basis points for the loan. And so, we look at shorting, and it's just a kind of liquid markets transaction. But when you actually try to explain,
you know what they said no. You didn't say you want to be given collateral. you've got to collateralize all of your shorting, and I think that's the key part. Is that it's going to be collateralized. It's going to be margined every day. I think. Some of the regulators in certain jurisdictions just don't understand that part. That there's significant collateral backing up those short sales, and you have legal obligation to return those securities when you recall them, or when you bought them back and you're ready to return them.
But that's a problem as well. So then we entered into the collateral discussion, and even with some of the larger sophisticated banks in Africa, the collateral they wanted was 4 times whatever we wanted to borrow. And so, if I want to borrow, $1 million worth of securities, but I have to park $4 million of securities that I can't trade, the economics.
That becomes a liquidity issue.
Yeah.
Yeah, it's definitely a liquidity issue. I mean, in your larger markets like South Africa, you charge 5% in terms of the haircut, not 400%. And that's purely because there's so much more liquidity out there. If there is an instance where you've got to buy back the shares in, say, for example, a Nigerian market that trades $30, $40 million a day, and you've shorted $20 million worth of a specific share, you can move that price massively intraday. So you're going to have massive moves in the price of securities if there's a short squeeze or if you're being recalled and that kind of stuff. Hence the likelihood that they will ask for a lot more collateral cover, 4 times as much. Yeah.
Well, I wonder if this is just indicative of a common issue, which is that we're trying to sort of impose developed, sophisticated American-style or Western-style financial engineering on markets that aren't quite ready for it yet. I mean, we have some very underdeveloped or newly developing capital markets in Africa. And as you say, you kind of march in with this sort of New York idea that you can do all these different things that are just inappropriate. So
maybe just a couple of ideas. I mean, from a policymaker's perspective, I mean, so basically, let's say just you have a typical case of a market where foreign investors will be more sophisticated, and the domestic ones, let's say, are more like buy and hold. So the issue you have here is of volatility, right? So this is hot money, which is coming in, and then which has potential impact also on your exchange rate. There's one reason why the rand is one of the most volatile currency in the world, because if I understand well, it's used as a proxy for tons of things. Whenever there's volatility in emerging markets, South African markets are liquid, so dump your rand assets and get out, right? So South Africa can manage that volatility, but imagine a smaller market and then with all the hits it can take on this exchange rate, right? So typically, so the advice from the IMF and the World Bank will be, well, this issue of liberalization of the capital account, that you have to sequence it and then put your fundamentals, your market infrastructure and so on, and know how to manage that volatility, right? So for example, in Ghana, if you go in the domestic bond market, they don't allow foreigners to come in the long end of the yield curve, right? They just allow them because they feel they're not ready yet. So, I mean, so there's this issue of also impact on the macro, impact on the exchange rate, which is important. So coming back to another issue is the investor base. What type of investor base do you have? I mean, just anecdotal evidence from, I'm from Senegal, which is a pretty small country. When I go back home and I talk to some investors, the local ones, they're very interested in the stock, investing in stocks, but only to get the dividends. They don't understand this capital gains and the valuation. It's very easy. It's like, how much dividend do I get every year? Okay? And then it's almost like a fixed income too. So if it is the case, then maybe there's room there for some market participants to develop some of these instruments. If it is what you see, so they're not there for the liquidity, they're there for the income. But maybe you have some other investors who are there for the liquidity. And then you have to ask a question about the funding too. And why is private equity so successful compared to the exchanges we have, right?
Yeah, we're going to move on to that in a minute, actually. But just before we get to the private equity piece, which I think is going to be fascinating, I'd like to talk about regional market integration. You've touched on it. It's a key topic in Africa at the moment. There's, as you say, there are some regional stock exchanges being created. What are the benefits of that? What are the disadvantages? I would hazard a guess that one of the benefits is that you create larger pools, so then you get more liquidity, and that then attracts more people to list. But the disadvantage is, you touched on one, the nationalist aspect of it. So can we discuss that? Who wants to launch in on this?
Well, I'll say one thing first, and it goes back to your question of like, hot money and how do we develop capital markets to control volatility, this type of thing. I think there's a lot of things that we ask of our, capital markets infrastructure that they're just not capable of doing. And, controlling hot money is absolutely one of them. I don't think there is really, you can look across the globe and say, what are the examples of markets that have successfully, mitigated volatility by the way they were set up? And really the only one that comes to mind is Tanzania. It has, for very particular reasons, they have a 60% foreign ownership limits, and that 60% is taken up by parent companies that own the local subsidiaries. So, you control the volatility, but your liquidity is essentially zero. Middle East, almost all countries have foreign ownership limits. Didn't help them at all in 2008. Dubai was down 80% one year, and it's up 80% this year. So, on the question of regional exchanges, I think it's kind of the same thing. People say, well, if we're taking a bunch of small fragmented markets, let's lump them together, that'll increase liquidity. And I guess I don't quite see why, because the thing that increases liquidity is having very large companies, that are profitable, that people want to buy and trade. And so taking kind of a series of small companies, putting them in one place, it helps on the margin in terms of things like, maybe now you have a single custodian, et cetera, but I'm not actually sure that it achieves that goal of making things liquid.
Right. So, Brad, I in a conversation I had with you before, you mentioned that you were in favor of regionalization, that you feel that's the only way to go. What would you say about it?
Well, I think, and hard to disagree with many of the points that Alison made, but the issue with multiple exchanges is split liquidity. So to the extent you're able to aggregate volume, then that has to be a good thing in terms of price discovery and hopefully capital flows. And then the other thing, which I'm hopeful is going to happen, and you're starting to see it, is that the JSE has the best platform in Africa, and it's actually arguably one of the best exchanges in the world. And you're seeing effectively the JSE running the underlying technology of a number of these smaller exchanges, so that exchanges can maintain their identity but have this best-in-class backbone. But I'm hopeful, particularly in the EAC, that as you see increased integration of that economic group, that you will start to see movement when it comes to the Ugandan, Kenyan, and Tanzanian exchanges. An example of that would be, it actually goes to the point about creating organic supply. You had the electricity distribution company, Umeme, was privatized. It was acquired by Actis. They basically restructured.
That's a private equity company.
Correct. Put in place professional management, did a great job of reinvigorating a moribund public sector utility, effectively, and then took that public. But there wasn't enough liquidity or demand in Ugandan institutional investors, so they ended up doing a dual listing at Nairobi and Kampala. And maybe we'll see more of that as a precursor to the idea of these regional exchanges.
But so in that case, would you, in retrospect, advocate that they only listed in Nairobi?
No, it's difficult. You have a Ugandan utility where they were really trying to use this offering to increase retail interest. Very difficult to tell someone living in Mbale that, oh, and by the way, you're going to be acquiring a share in Kenya. That's
right.
So it's difficult to fit all of your goals into one model. But this, I think, was a helpful incremental step along the journey.
And I think Brad's absolutely right that we started off originally, the JSE had this plan, about 10 years ago that just never quite went through, of kind of literally integrating all the exchanges, so there would be a single, Southern African exchange, a single East African exchange, and it just never happened for the obvious reasons. Everyone wants their own domestic capital market. The local brokers didn't want to be kind of put out of business by more sophisticated South African ones. So where we've come today is this issue of kind of making it easier for to convert shares. So if you buy, say, Umeme in Uganda and you want to sell it in Kenya, it used to be that you'd have to go demutualize, get the share certificate in Uganda, drive it across the border, deposit it in a Kenyan bank, and then sell it. So now they're trying to set up systems to do that electronically. And I think Uchumi now is kind of doing the opposite. They're in Kenya and cross-listing in Uganda. So I think that'll be for a long time. The first step is just making it easier to convert shares across exchanges.
Terence, what do you feel about regionalization?
I think it's definitely a good thing. I mean, it just gives investors a wider base of assets to look at investing in, and from a raising capital perspective, you've got a wider base of investors to look at, which to consider. I think it'll drive costs down. Returns increase. Infrastructure projects get more, commercially viable because of costs coming down. I think it's a good thing, but whether it happens or not is yet to be said. I think the best we can hope for is more sharing of technology and ideas between the various exchanges, as opposed to full-on regionalization of certain exchanges. I think that's
maybe. I think stock markets and bond markets are different animals, but in the bond markets, you have very successful of regionalization, again, in the West African Monetary Union. So you have 8 countries, 1 central bank, 1 common currency, and they've gone from a situation where actually the central banks were lending money to the government with all the problems, inflation and so on, to a situation, with the help, by the way, of technical assistance from the US Treasury, where any government can issue within the union, and any investor within the other 8 countries can buy the bonds, right? Treasury bills, bonds. So, and then in that region, you had banks that had excess liquidity. So now, they've been able to mop up some of this liquidity and create a kind of vibrant and growing regional bond market. It's working pretty fine. And I think in the CEMAC countries, this is Francophone Central African countries, either they have started or they will start the same. So that it worked fine. But again, they have the same currency, they have 1 central bank. But it really helped. Yeah.
And the great thing about that is that it keeps the capital, the returns of those investments in the region. It doesn't leave the region, and it just creates more growth and stimulates the economies of those regions specifically.
Right. Well, that actually relates to the next question, which is about private equity. My perception is that private equity has been tremendously successful in Africa. There are obviously nuances to that. But can we just talk about why private equity is successful and whether that's going to have an impact on the public equity space? Perhaps you could start, Brad.
Sure. So I would agree with you, Dan, that private equity has been successful. If you look at both there was a Credit Suisse report last year that came out that showed relative emerging markets returns. Sub-Saharan African private equity stacks up quite well. Similarly, if you look at the IMF, their top performing funds within their very large private equity portfolio are in Sub-Saharan Africa. Part of it has to do with just the fundamental drivers of growth that I'm not going to bore this audience with. You know them intimately. Another part has to do with simply just the provision of capital to sectors that have been undercapitalized, driving growth. I would though caution about private equity, because I think there's a lot of hype with regards to the private equity market in Sub-Saharan Africa. And similar statistic to Allison's, there are actually 58 Sub-Saharan private equity funds now, more or less, or people in the process of fundraising. And you have someone, and let's just say, nothing disparaging, but let's just take a very, very large US fund management complex. It's difficult to move to Africa, think you're going to raise $1 billion and apply a traditional model of basically levering up when there's no domestic capital market on the debt side and a limited leverage loan market as well by which to do so. So I think that while private equity has been a successful asset class to date, particularly in South Africa, and then there's some superb groups like Helios who've done well, but I think it's going to get trickier in terms of looking for those late-stage LBO-type models, and people are going to need to migrate towards different business models to achieve the returns that investors expect. Sorry for the long-winded answer.
That's fine. And do you think it's getting too crowded, or it's going to get too crowded as more funds launch, attracted by these stellar returns?
I just think it's a question of markets are, even sub-Saharan African markets are efficient, and arbitrage opportunities get arbitraged away. But in terms of your opening question, private equity force for good, I would say so. I mean, in terms of attracting capital to the region and helping find solutions to meet unmet local demand, it's a tremendous force for change.
And what about in terms of private equity helping to develop the capital markets by encouraging people to put money into public equity, perhaps as they sell out, or just generally sort of increasing the level of investment in the continent?
I'll make one more comment, and then I'll stop speaking for a little while so my fellow panelists can chime in. But I'll say something a bit perhaps counterintuitive, which is that interestingly, and just another interesting report that came out is Ernst & Young published a report tracking exits in private equity in sub-Saharan Africa. And there's good news in terms of a common complaint about private equity in sub-Saharan Africa has been the limited exit possibilities. But this report actually showed that exits are increasing in sub-Saharan Africa. The bad news in terms of your question about capital markets is that IPOs remain a very, very small percentage of the route to exit. And in point of fact, which actually I think is a good thing, is that it's regionally driven M&A. So you don't necessarily, surprisingly, you don't necessarily have multinationals coming into Africa, but you have domestic or regional champions acquiring private equity-led companies, which I think plays well with a lot of the themes we talk about, such as the regional integration, building up of real domestic, and as I said before, regional champions. That's going to be a net good thing, but you're not necessarily going to see a boom time in IPOs in sub-Saharan Africa.
Right. So, Amadou, you've been frantically writing something over there.
Hopefully
Does it relate to this?
Disagreeing with me.
No, I'm just learning a lot. I mean, so I worked a bit on Italy, and one problem they have lots of small and medium enterprises driving the growth, economic growth, but they're not listing. They're not interested in listing, and if you ask them, it's a big smile. It's issues of disclosure, transparency, tax, and so on. So and then so basically, if we come back to basically just the plumbing, the basic plumbing of a financial system, lots of things that we take for granted here in the U.S. The bankruptcy law, the legal system, the contract enforcement, and all these things it's running so smoothly here, and not that well established in other countries that maybe private equity is a natural way to go. Sometimes, even if you are in the board, it's a closer relationship than being listed out there. Yeah.
Terence, you mentioned earlier that you were concerned about the flow of dividends out of the country related to private equity. Can you talk a little about your concerns about whether private equity really does benefit the country in which it is?
I think it benefits the institutions that private equity gets involved in. I think there are more efficient ways to do things, and they more often than not turn companies around and make them more profitable. But I'd like to see a percentage of dividends staying in the country to promote infrastructure or promote growth in the country itself, where the returns are earned, as opposed to just repatriating all of that back to the home country of the private equity investor. So it's money made in the country. A portion of it, I would think, should stay there to benefit growth in the country itself.
I'm not going to elect you to any African office. That's a policy.
That's the downside to my thinking, is that international investors will never go for that. But how else do we keep money in the country, and how else do you grow the economies of the country? If money is just being siphoned out, left, right, and center. So it's a tough one. You know, it's I'm definitely not smart enough to come up with a better idea.
Maybe if I may on that, I mean, just the way I see it, it's not actually like having foreign investors coming in and out of equity markets increases liquidity to some extent, though it comes at the price of high volatility. But I think it's not a bad thing. I think when we're talking about the money going out, really the big portion of the money is you know, illicit financial flows. So you have this Kofi Annan report, Africa Progress Report, which shows, for example, how actually foreign direct investment, which is the darling of all policymakers, sometimes ends up with a lot of outflows when you know, you have companies coming and having this tax arbitrage and tax optimization and so on, you know, intra-group borrowing, and a lot of the money goes out. So I think on that point, I think having the portfolio flows, it increases liquidity and you have some more volatility. But where you have to be careful is, you know, when you have this big mining company that comes and say, by the way, I can go next door, this is a contract signed, and you don't have your tax advisors and your super lawyers that make sure that, you know, you don't end up with these illicit outflows. So, but if I may, when it comes just taking a macro point of view, one maybe advantage of private equity is that, I mean, I'm saying to sustain the growth in Africa, you need transfer of knowledge, you need transfer of you know, just good practices and so on. So hopefully by having private equity managers that come and help these companies be run in a more efficient way, that's very important for growth in general.
We've seen strong private equity flows coming to South Africa over the last year, 2 years as well, and additional flows coming in. You know, there's always reports in the newspaper of a new private equity company coming in or allocating another $1 billion to private equity in South Africa, where South Africa's based, and those companies are looking to explore into sub-Saharan as well. So you know, I don't think there's been much you know, stemming of the flow of private equity money coming into the country.
Right. Well, it certainly seems, based on what you were saying, Amadou, that the transfer of expertise is a benefit. But so, just looking back at capital markets again, one of the key characteristics of a functioning capital market is transparency. And one of the key characteristics of people's perception of Africa that haven't been involved there is that it's not transparent. It's a you know, I think I read the same Ernst & Young report that you read, and one of the comments in it was really quite surprising, which is that nearly 90% of the companies that are already investing in Africa view it as the most attractive region in the world in which to expand. So 90% of those already invested. More than 50% of those that don't invest view it as the most unattractive place in the world to invest. So those who haven't had any involvement in Africa still view it as an opaque, dangerous, corrupt, difficult place to do business. And it strikes me that the role of the capital markets in Africa is to try and address that. That's a key aspect of what they're trying to do. So I wanted to ask Alison, actually, as an investor, you know, what's been your experience in practice of operating in Africa? Is it the opaque, corrupt, difficult place to do business that people think?
Well, I think we only trade listed debt and equity, and so our experience would be very different from someone in private equity. But in general, I would say, you know, that's normally the first question that we get from new investors is, you know, isn't it all just kind of corruption and embezzlement and nationalization and civil wars and this type of thing that you mean when you think of frontier markets? And the answer is, you know, I've never lost a dime to any of those. The ways that we lose money, if I had to kind of come up with my top list, number one would be erratic government policy. And by this I mean, you know, I think Bangladesh to me is always the best example. In Africa, we've seen a lot of kind of changes in mining sector regulation that affect individual companies, but, you know, it'd be things like Sri Lanka, Bangladesh, when they want to promote the capital markets, they'll ease margin borrowing requirements. So individual retail investors can borrow lots of money, you know, go out and trade stocks. When they think the stock market is getting into a bubble, they'll restrict margin lending. the stock market will go down 30% in a day because all of a sudden everybody has to sell. So it's things like that. I guess in Africa it's been a bit more stable, but a lot of countries, for a long time, mining legislation, for example, wasn't a huge issue because just no one was investing. Or they were having a long investment cycle where no one, they're putting money in but not taking money out. In the past few years in the mining industry, we've hit this place where mines have been developed and now there's a lot of cash coming out. So all of a sudden the rules change. So a lot of the natural resource companies that are listed that we look at have kind of, woken up to some new experiences. So it's, that type of thing. Other risk factors, we've talked a lot about kind of what's the investor base. I would say other people's money is also a huge risk for us. I mentioned emerging markets funds kind of getting into Africa and getting into frontiers. And this is a group of investors that are kind of dabbling. They're putting a toe in, they're seeing how things go in Nigeria, how things go in Kenya. But when risk appetite wanes, the first thing they sell is frontiers. And so for those of us who are kind of stuck there, that's a big risk factor. Changes in global risk aversion, the fact that there's no way to hedge. So far, leverage hasn't been a risk, but I think it will be, and it's certainly a risk, coming from emerging markets funds that are levered. And hence, when they have to delever because of something happening in Brazil, they might sell their Nigerian exposure. So, yeah, corruption, civil wars, no, but government policy, absolutely.
And Allison, do you follow UN PRI? The Principles of Responsible Investing, is that part of your screen?
We find that most of what we do kind of falls into it anyway, so I'd say, not on paper, but yes, in practice. And do you look at Transparency International scores when you enter a market? How important is that corruption funnel? No, well, funny enough, we look at almost no kind of big numbers at all. Like people ask about GDP growth, for example, and do we kind of orient, we cover 60 different countries, do we kind of rank them by GDP growth and look there first? Or, this type of thing, Transparency International. I find that those kind of macro level numbers have no correlation at all to returns that we can get on the stock market. And actually to kind of returns that the companies are getting on the ground. So in short, no, not so much.
Is that specific to frontiers, or is that something that you would say is a general?
There's in emerging markets as well. Yeah, that kind of inflation and interest rates might be maybe the only two factors that do seem to have some influence on stock market returns and how well companies are doing, but GDP growth, country risk rankings, these types of things, none at all.
Right, because it's things like GDP growth that's really driven this kind of tremendous interest in Africa and in frontier markets.
Well, yeah, and a quick story about that is, one of the big problems we have kind of picking individual stocks is, yes, everyone looks at Africa and they say, really strong GDP growth, urbanizing, middle class, the whole consumer story that you know so well. Then you say, okay, well, we have to pick stocks. And so the obvious thing is, well, let's look at PZ Cussons, let's look at Unilever, the breweries, the telcos, et cetera. And you find that those macro level factors, at best, they might translate to the top line. So we'll see, consistently, for example, in Nigerian consumer companies, they tend to post very high top line growth, 15, 20% every quarter. Get to the bottom line and, they're lucky if they're breaking even. So, why? Just the obvious reasons, cost inflation, competitive pressures on pricing, et cetera. So you can say, yeah, to get from kind of, not only from GDP growth, but even from something like, people buying more soap down to, are we actually making a profit? Huge disintermediation.
You mentioned the PRI, the Principles for Responsible Investing. I'd like to ask the whole panel this, really. Do you feel that there is an underlying social theme in a lot of investment into Africa? And is that something that the capital markets or the people running the capital markets can tap into or should be aware of in terms of how they structure capital markets? I mean, it feels that any investment in a country that is still struggling to provide clean water for many of its citizens, any investment in that country is probably likely to have some social component or some social benefit. But is that something that you, as individuals, have seen or witnessed?
Well, I take a lot of comfort in the fact that that the people who follow companies that rank in the top quartile of principled, responsible investing metrics outperform the market. So there is this nice correlation that if you invest with people who operate with best-in-class standards of corporate governance, guess what? They probably run their business better than other people. So I think that creates a virtuous circle. To another point, and I'll be a bit disparate in my response, I think part of the opportunity in Africa and capital markets is what that perception arbitrage, the delta between perception and reality. And so I'm delighted that there is a group of people who still are concerned about the basics of corruption because they're simply just not recognizing the pace of change on the ground. And then the final question in terms of how does it impact us specifically, and partially to some of the comments that my colleagues were making on the left. We won't invest in extractive industries. We firmly believe that the way to contribute meaningfully to and profit from Africa's continued transformation is to focus on meeting domestic demand, not exporting.
Terence, I know you've got a fairly substantial, strong view on this.
I think it's a key area for financial services in Africa as well, to always give back. And having been fourth generation born in South Africa, I think I'm more African than I am Indian. So I think it's not this that determines whether you're African or not. It's what's here in your heart that determines whether you're African or not. And I think every financial services business, or every business in general, needs to have that mindset that you're responsible for your country and for your continent and for the growth and development of that country and continent. I mean, we've all got to realize that we need to be the change that we want to see in our countries and our continent at large. So, from our perspective, we've set up a bursary foundation, so profits from the business go toward providing bursaries for previously disadvantaged kids. We have a legacy of apartheid. Previously disadvantaged predominantly means non-white kids that have done well at school and want to progress to university. So that's, I think education is the key to changing or unlocking potential in these kids and changing not just their lives but the lives of the people around them. You need to see a lot more of that. Transformation is a big issue in our country because of the legacy of apartheid. We need to see more non-whites taking up quite senior positions in banks, in capital markets, in financial institutions and the like. I would love to see more done. I don't think there's enough done from a South African perspective. There's a fair amount, but it's not enough.
I think it's a difficult question, but personally I'm very pragmatic. I think, for example, so if you look at financial sector in Africa, microfinance is there and it's trying to basically address a gap, right? So it's working very well. Then you have the banking sector, which is lending, but it takes approximately, I'm not a banker really, but the cost for studying a $1 million and $100,000 credit application, it's pretty close probably. So then you have this missing middle who do not have credit, right? And then, for for last time I saw this Harvard professor of finance who won a prize because he said, well, wait a minute, why are banks not really lending to this missing middle, right? And he developed a psychometric test. Basically, you enter a bank, there's a computer, you answer a number of questions, and it gives you a score, right? because in many countries it's difficult to have the data and so on to do the credit scoring, right? So I think we need innovation there, innovate, and that's one way where the financial sector, the banks can help. If there is socially responsible investment that is interested, well, make a case for it. If there is Islamic finance, financial flows out of Dubai and the Gulf, which is interested, infrastructure funding is perfect for that, right? Because you can just have a SPV and the toll road fees will go to pay the sukuk securities holders, right? So I think at the end of the day, it's good to just basically what I would like to see more is having, especially the local financial institutions, instead of just going with the status quo, right? Innovating to fill the gaps that exist, right? And
are you seeing that happening?
Would be mobile banking, for example, right? So I like very much an example because they make money out of mobile banking. It's not philanthropy, but it's just if your job is to intermediate the money from the savings to hopefully growth enhancing investment, well, innovate. Try to address the gaps, right? And avoid the rent-seeking situation. So I welcome everybody, the foreign investors, private equity, but fill in the gaps. Get the engine going. Yeah.
Thank you. On that note, I'd like to ask the audience if you have any questions. We've covered a lot of ground, but so in the blue tie.
Yeah. So pertaining to that last point, is there much securitization going on with kind of smaller loans within any of the markets, and are those securities in demand, or do people tend to not touch them?
Does anybody know the answer to that?
I haven't. It must be the expert on securitization. but just to turn your question differently. For example, agriculture, right? What are the financial innovations when it comes to agriculture? Do we see these warehouse receipts, right, and so on? That could be a type of securitization that could be very useful. Maybe it exists. And for example, in Ethiopia, they also created a commodities exchange. And South Africa has a maize futures on the maize contract. Malaysia has a futures on palm oil, right? Which goes into Oreo, by the way. It goes into everything.
And actually, one of the areas where we've seen quite a lot of it is kind of wage-based lending. So companies that say a person works for the government, they have their wage paid into a certain bank, and they can borrow a certain percentage of their salary, and it's essentially the repayment is deducted directly from the salary payment. There's a company that we own in the portfolio in South Africa that is responsible for government benefits payments, Social Security, poverty payments. So they'll make microloans of, say, if a person's getting 300 grand a month, they'll lend them 150 and then deduct it in 5 grand increments, from their benefit payment. So that is, I think, the main area where we're seeing some type of, I guess you could call it securitization, but that also fills the gap with the microloans.
There's been massive increase in microloans in South Africa, almost to a point where there's talk of it being a bubble and bubble bursting, and you've seen certain banks that derive a large portion of their income and profits from microloans take quite a knock over the last year or so, purely because it seems as if that bubble has sort of.
I think we've got time for a couple more questions. So, sir.
Yes, good afternoon. Probably beginning from Shea Textile. We're a textile company, green textile company in Kenya. And you just mentioned microloans. You had mentioned social ventures. What is, I see there's still a missing middle in regards to funding and support for social venture and social impact funding. Could you address that?
I'm happy to. So at Mara, we have something called Mara Foundation, and we're really focused on entrepreneurship. So we have incubators in Kampala, and Dar es Salaam. And then around that we have a mentorship program. And then around that we have micro venture capital in order to try to create an ecosystem of entrepreneurs who then give back. The issue from what's difficult from an investing perspective, though, is putting together SME funds who are backing social enterprises and small and medium-sized businesses. And part of it is simply just the cost of administering those funds. No one has found the secret sauce. So, for example, raising $50 million and dispensing $10,000 to $50,000 loans is really hard, because think how many credits you're analyzing once you're fully invested versus a private equity model of 8 to 12 investments. And you're absolutely right, sir. That's an area where I think a lot of people are trying to put their heads together. You have organizations like Endeavor Global. You have a firm called Chicana. And people are trying to figure it out. But that's definitely an area where it's hard.
Does crowdfunding fit into this space somehow?
It's interesting you say that. There's a company founded by a Danish guy that does crowdfunding for loans. So basically, if you want to buy some credit, for example, of some entrepreneur, you can go to this crowdfunding site. The name escapes me. It's My Something. But people are starting to think in those terms.
It's definitely starting to become a theme in South Africa as well.
Crowdfunding thing.
Crowdfunding, internet-based, and all that kind of stuff. From a loans perspective for SMEs and the like, we've got a few government institutions like IDC, Industrial Development Corporation of South Africa, the National Empowerment Fund. There's some private organizations called business partners that you can go to for microloans and financing for your businesses. So what seems to happen sometimes is that the red tape just gets a bit too much, and you almost need to streamline that funding a little bit more. Unfortunately, the National Empowerment Fund is currently bankrupt. It's just you need lots of transparency. You need strong leadership. And you need accountability, and I think that's one of the key things that we seem to lack in Africa is accountability, and sort of being redeployed into another area. If you screwed up, you should be fired, and buck's got to stop somewhere, and I think that's what we need to push for a lot more accountable institutions, especially if they're government funded. Because I know Brad, I shouldn't just be giving him a loan because he wants to start up a business. It should be based on merit, completely on merit, and that's unfortunately the case that's been happening in our country quite a bit. A lot of nepotism, a lot of corruption. It's about who you know, and that needs to change significantly.
Sorry, one more comment on this theme. And something that everyone in this room can get involved with is that there are these terrific angel networks that are popping up. You see them in Accra, Johannesburg. You have this great iHub in Kenya. So I'd encourage people to check out what's going on on the ground, because you are finding ways to get money to good ideas.
One more question, yeah.
For Allison about fundamental year strategy, spoke a little bit about investing, talk specifically about fundamental investing in Africa, Brazil, or experience elsewhere, or kind of, you said that GDP is not necessarily a driver of what you think is back, because maybe Nigeria, the bottom line is great. Top line.
Yep.
So talk a little bit about what do you think is attractive, or what opportunities are you looking for in Africa?
I guess.
Did everyone hear that question? It's really focused on whether GDP is a driver of investment and what Alison would actually look for in an investment in Africa.
I guess, in all honesty, since there is such a limited supply of kind of listed companies, what we tend to do is just, we know all of them and kind of find one that has a story. But the type of story that we're looking for would usually be a case where there's some type of bottleneck, and resolving the bottleneck has high barriers to entry. So, it's hard to find things that fit that specifically, but maybe one example would be, there's a company called Trans Century in Kenya that has the concession for the revamping the Kenya-Uganda rail line. Of course, transport all around the region is a huge bottleneck for everyone, and there's high barriers to entry because they put 100 million plus into revamping this, and of course, you're never going to build a parallel rail line. So, of course, contingent on a million other factors, like that would be one that we would look at and say, here's an interesting story at least. Other things might be.
Sorry, even though it's a Harvard MBA, not a Wharton MBA.
Yeah, indeed. Yeah, the whole team was Harvard. But yeah, we'll let that one slide. What else? Something like, on the consumer side, I personally believe that mobile phone companies, in terms of tariffs, it's a race to the bottom. A lot of the margins get competed, soap and shampoo and stuff margins get competed away. So we kind of look in the consumer sector and try to find something a bit different. Healthcare is one I like because it's a bit harder to compete away margins when you're talking about do you really want to go to the cheapest heart surgeon? So we tend to find that the profitability holds up a bit better. Just kind of little niches here and there where you can actually sustain profits.
Maybe if I can just I just attended a presentation before, just coming back to whether these, these indicators of transparency, accountability, and so are important for investors. And so this professor was regressing capital flows on a bunch of variables, and someone asked, well, why don't you put this Transparency International, all these basically measures of institutional quality. And he says, well, when you put GDP per capita, those don't matter anymore. So apparently, it seems that there's a correlation between those nice indicators and GDP per capita.
Okay, great. Well, thank you very much for being here, and thank you very much to all our panelists. I think it's been a fascinating discussion. We'll be standing around for a little while, so come and down and talk.